Alright, so now that you have learnt how to determine FCFF and FCFE, next thing is to put these cash flows into the process of computation where actually the valuation has to be done. So by far all the examples that we have taken were targeting computation of FCFF and FCFE. But what ultimately we want to do is to find the value of the business or the value of equity, right? So that valuation part is going to be simple. You just need to use the same Gordon's model that you have learned initially as dividend discount model. The only difference is when you compute the value of share or value of equity through Gordon's model, you always mention that as P0 equals to D1 divided by KE minus G. P0 value you still have to compute. The base of your computation in Gordon's model originally was D1, that is expected dividend by end of the year. Now you are going to take the expected cash flow after 1 year. So instead of taking D1 as the numerator, you will be taking FCFE1 as the numerator. So P0 equals to D1 divided by KE minus G. You need to replace that by P0 equals to FCFE1 divided by KE minus G. Now those things you have already learnt. So if I tell you the holding period being 3 years, what will you do? Recollect, what will you do? You will take FCFE1 divided by 1 plus KE raised to 1 plus FCFE2 divided by 1 plus KE raised to 2 plus FCFE3 divided by 1 plus KE raised to 3, and because it is 3 years, at third year end there will be always some terminal value, correct? So the terminal value is also available at the end of the third year. Then you take the terminal value, that is TV3 divided by 1 plus KE raised to 3. So in that chain you cannot ignore the terminal value. If it is directly P0 computation, then you just have to focus on FCFF1 divided by KE minus G, because that indicates the infinite holding period, correct? That indicates the infinite holding period with constant growth. Now, if you want to arrive at the value of the business, I repeat, if you have to arrive at the value of the business instead of arriving at the value of equity, your base will not be FCFE, your base will be FCFF. But you use your brain over here and identify one important thing. When you are trying to compute the value of the business, what you will have to do? You cannot take your cost of capital as KE, because KE is the cost of equity. But when you are talking about the entire business, your cost of capital cannot be KE. Your cost of capital has to be KO, that is basically weighted average cost of capital. KO stands for weighted average cost of capital. So you would have learned so many times how to determine weighted average cost of capital. So many a times in exam questions, weighted average cost of capital may be informed to you directly, or as part of the calculation you might have to determine the weighted average cost of capital as well. So the discounting rate for value of the business will be weighted average cost of capital. Discounting rate for value of equity will be cost of equity. In other words, if you want to determine the value of equity, your discounting rate has to be KE. If you want to determine the value of the entire business, it has to be overall cost of capital as your discounting rate. So when I say KO, O over there indicates overall cost of capital, and the overall cost of capital is nothing but the weighted average cost of capital. So let us do one thing. Let us write some notes in this regard and then I take you ahead. So in your notes, first you write the heading cash flow based valuation models. For determining the value of the business, you take V0 equals to FCFF1 divided by KO minus G. Now please look at these variables. When you write V0, it is V0. This is not K0. This is KO. This is KO. So KO minus G, where FCFF1 is the free cash flow to firm expected at year 1 end. G stands for the constant growth rate. KO is the weighted average cost of capital. So please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this, let us move ahead, and under the heading cash flow based valuation models, now you will write for determining the value of the share, it will be V0, you can also write P0, that will be FCFE1 divided by KE minus G. Keep in mind one thing, when it is the value of business, you must use the variable V0. When it is value of the share, you are freely allowed to use the variable either P0 or V0, but the base of computation will be FCFE and the discounting rate will be KE. So FCFE1 is the free cash flow to equity expected at year end 1, and G is for constant growth rate, KE is the cost of equity. Please write up this as well and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead. And now we write some important notes. The selection of discounting rates will obviously depend on the type of cash flows. If the required amount of cash flow to be discounted to its present value is the free cash flow to firm, that is FCFF, then the discounting rate to be adopted should be the overall cost of capital, that is KO. However, if the amount of cash flow to be discounted to its present value is free cash flow to equity, that is FCFE, then the discounting rate to be adopted shall be the cost of equity, that is KE, or the equity capitalization rate. So please write up these important notes and then I take you ahead. Alright friends, once you have completed writing these entire notes, let us move ahead and take up the next example, that will be example 3. It says the cash flows of Yes Limited are given below. The cash flows are in millions of dollars. Year 1, 2, 3, 4, 5, and they have given you the net cash flows. Earnings would have witnessed 5% constant growth rate after 5 years. The cost of capital is 15%. You are required to compute the value of Yes Limited. The present value factors at 15% for years 1 to 5. The question itself has indicated the present value factors or the discount factors. Now, what is important? You need to assess the value of this business. So first thing that you need to understand is any question targeting the valuation of the business or valuation of equity? Reading this question, what hint do you get? Is it about value of business or value of equity? Obviously, it is case of value of business. So the cash flow that you need to pick should not be FCFE, but should be FCFF. However, the question has no complication because it has directly reported the net cash flows. But look at one thing, right from the beginning, we don't find a constant growth in the cash flows. Look at the pattern of cash flows. Year 1, $175 million. Year 2, it is $200 million. Year 3, $320 million. We find that the cash flows are growing, but they are not growing at a constant growth rate, correct? It is evident. Without using calculator, you can say that there is no constant growth that we are observing. However, after 5 years end, the cash flows will constantly grow at 5% every year. You can take the FCFF of 5th year, on that you add 5% growth rate to make an estimate of what would be FCFF for 6th year. Then what you do, you compute not V0 but V5. V5 will be FCFF 6 divided by KO minus G. I am saying KO because it is the overall cost of capital that you need to consider. So you will get V6 value. Sorry, you will be getting V5 value. Once you get V5 value, that V5 value can be considered as the terminal value at 5th year. Then you have cash flows for year 1 to 5. All these cash flows will then be discounted to their present value using the discounting rate as the overall cost of capital of 15%. And the discount factors are already given to you. You just need to make the present value computation. So before you start your solution, you need to plan how you are going to approach it so that your clarity of process of calculation is also there, and this planning of your solution makes sure that you are not missing out any point that will be involved in the calculation. Let me tell you, these are very simple examples that I am initiating right now. Gradually the complexity will rise, but before I take you to the complex calculations, I would want you to have complete comfort and good level of understanding at this particular stage. So let us do one thing. Let us write up the solution over here. In your solution, you first determine the terminal value at 5th year end, that is TV5, or you can also call it as V5. So V5 or TV5 will be FCFF 6 divided by KO minus G. FCFF 6 is not directly given to you, so you can pick the 5th year cash flow and add 5% growth rate to arrive at 367.50. Then the terminal value calculation you can easily make as $3,675 million. Write up this calculation and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and continue further. Your calculations now will be for the next 5 years cash flows 1, 2, 3, 4, 5 and 5. We have written 5 twice. This first 5th is for the free cash flow to firm for the 5th year, and the second 5th what you have written is for the terminal value at end of 5th year. Both of these cash flows along with the other 4 years FCFF will be discounted to their present values. So cash flows for the first 5 years were given in the question itself. This is what we have ascertained, correct? And now the discount factors were also informed to you in the question itself. Keep in mind one thing, both of these are 5th year cash flows, so their discount factors will also be the same. Multiplying the cash flows to their discount factors will give you the present value of these cash flows, and taking the aggregate of that will give you V0, which comes to $2,709.34 million. So please write up this calculation as well, and that will be end of the solution. Alright friends, once you have completed this entire calculation, now let me show you how to make the calculation through your financial calculators. So your BA2 plus calculator. So what you need to do, turn on your calculator and then press CF. Then for clearing the old work, you press second and CEC for clearing the work, second and CEC. Then it will be demanding the input for 0 year, because there is no cash flow at 0 year. You input 0 and press enter. Then for the follow-up steps, you press the downward arrow key once, input 175 and press enter. Then press the downward arrow key twice, 1 and 2, then input 200 and press enter. Again press the downward arrow key twice, 1 and 2, input 320 and then press enter. Once again press the downward arrow key twice, 1 and 2, then input 340 and press enter. Then again press downward arrow key twice, 1 and 2, then input 4025. Now if you are wondering from where we got this 4025, this is the aggregate cash flow for 5th year, which is FCFF for 5th year plus the terminal value at end of 5th year. Both taken together it is 4025. So input 4025 and then press enter. Thereafter press downward arrow key twice, 1 and 2, then press NPV and it will demand the input for interest rate. So I by Y you input as 15, then press enter, then downward arrow key once and then press CPT, and your result appearing on screen will be NPV equals to 2709.34. So please write up all these steps and then I take you ahead. Alright friends, once you have completed writing these steps, you can check with what you have written in the table earlier. It is exactly the same value. Alright friends, once you have completed this entire solution, let us move ahead to the next example, that will be example 4. It says Tiger Limited has Bloodlust as a separate division. The division is likely to give cash flows after tax to the extent of $5,000 for first year, and such cash flows are expected to grow at 8% per annum up to end of 6 years. Tiger Limited has planned that after 6 years, this division would be demerged and disposed of at its terminal value, which is expected to be 15% more than the value based on perpetual growth. This is something important. Whatever value you arrive as terminal value at end of 6th year, the real terminal value will be 15% more than that value. So what you calculate initially will be as per the perpetual growth. You add a separate 15% to that to arrive at the expected terminal value, and then mention that the company's cost of capital is 16%. Net present value for 16% for $1 they have given you. These are all the discount factors at 16% discounting rate. So other than this 15% adjustment, the question is likely to be similar to the previous example. And of course here the cash flows they haven't given for all the 6 years. You will have to adjust 8% growth rate to arrive at those cash flows. So let us observe how to present the solution. FCFF1 is given as $5,000. So FCFF2 will be 8% more than that, that is $5,400. Likewise keep adding 8% to arrive at the free cash flows to firm till end of 6th year. And then one more time you will make this computation, correct? Because you would want to arrive at the 7th year FCFF, because the terminal value at end of 6th year will be based on that. So as per perpetual growth, the terminal value at 6th year end will be FCFF 7 divided by KO minus G, and that calculation when you make, you will get $99,179.65 as terminal value at end of 6th year based on perpetual growth. But the expected terminal value will not be this much. The terminal value will be 15% more than this value which you have originally arrived through perpetual growth. So keeping that adjustment in mind, the terminal value at end of 6th year can be re-estimated as $114,056.59. So please write up this entire calculation and then I take you ahead. Alright friends, once you have completed writing this entire calculation, let us move ahead and continue further. You just now have to make the computation of present value of all the cash flows that you have estimated. 6th year we have written twice so that you accommodate the 6th year FCFF as well as the 6th year end terminal value. All the discount factors were given in the question. Multiply and you compute the present value. The aggregate present value comes to $68,550.61. So please write up this whole thing and that will be end of the solution as well as end of this session.